If your financial advisor can't talk to you about tax planning, is that really the right advisor for you? High net worth investors assume their advisor is helping them keep more of their wealth. But the truth is, at most major brokerage firms, advisors aren't even allowed to provide proactive tax strategies. That's why you always hear them say, you'll need to talk to your CPA about that. This restriction could cost you hundreds of thousands in unnecessary taxes, and most investors don't even realize it's happening. But today, I'll show you why so many people are moving their wealth out of wirehouses and into independent RIAs, and how you can make sure you're getting the right level of financial planning. And before we finish, I'll break down one overlooked tax mistake that could be costing you more than any investment decision you've ever made. So stick around for that. For decades, the largest brokerage firms, often called wirehouses, control the majority of wealth management in the US. But today, something is changing. In 2010, wirehouses employed roughly 1/3 of all financial advisors. By 2021, that number had fallen to 25%, and projections show that it will drop to roughly 20% by the end of this year. Meanwhile, independent RIAs, or firms that aren't tied to corporate sales quotas or proprietary investment products, have been growing at a rapid pace. They now manage over $9 trillion in assets. And this shift isn't random. There are key reasons why both advisors and clients are making this move. Let's take a look at what wirehouses offer and where they fall short. Broker-dealers offer a sense of familiarity. They're big, they're well-known, and been around for decades. But with that size often comes a trade-off, one that's particularly important for investors with significant wealth. At big firms, many advisors say they act in your best interest, but what they don't mention is that they can switch between two sets of rules. One moment, they're a fiduciary, required to put you first. Other times, they follow a suitability standard, where they can recommend investments that check the right boxes, but may come with higher fees, commissions, or incentives that benefit the firm more than they benefit you. Many investors assume that because broker-dealers are large, they have better access to investments. But in reality, these firms often limit their offerings to proprietary funds, structured products, or model portfolios designed for efficiency rather than customization. This isn't just about investment selection, it's about control. Independent RIAs aren't locked into corporate agendas. They have full market access, which means investment strategies are designed around your goals, not around the firm's profit margins. But beyond investments, there's another area where independent firms provide a major advantage. That's when it comes to tax planning. Stock markets go up and down, and they grab headlines. But for high net worth investors, the biggest drain on wealth is something far more predictable: taxes and efficient estate planning. Unlike market risk, where this is something we can control if we plan ahead. But here's the issue. Many wirehouses restrict their advisors from providing tax advice due to compliance policies that limit their liability. Since commission-based advisors are hamstrung by heavy regulations, it's no wonder they focus so much on what the market did last quarter instead of long-term financial planning. But is that really the question you need answered? No. The real question is, how do you avoid paying more in taxes than you need to? Let's take a look at some strategies. One of the biggest mistakes I see high net worth investors make, assuming that deferring taxes is always the best move. Once required minimum distributions, or RMDs, begin, many investors find themselves pushed into higher tax brackets, sometimes even higher than they expected. That leads to more in taxes, obviously, but also higher Medicare premiums and fewer options to control their lifetime tax bill. So what can you do to stay ahead? Here are 3 strategies to help you manage your tax exposure. 1. Strategic Roth conversions. We can move pre-tax money into Roth IRAs before RMDs begin to control that taxable income later on in retirement. It's almost like that there's a tax rate valley between when you retire and when you start taking RMDs. Normally, for most investors, their income is going to be highest at the later stages of their career when they retire. Then once they retire, the tax rate is going to drop, and then it's going to pick back up again when RMDs start. So what's the goal? Let's pay taxes strategically when your tax rate is at the lowest, rather than waiting till you're forced to at a higher rate. Now, this is a useful strategy. Over a few years' time, we can strategically move funds from the IRAs to the Roth IRAs, intentionally paying taxes at that lower rate. Done correctly, this can save you 6 or 7 figures in taxes over your lifetime. Strategy number 2, tax-efficient withdrawal planning. We want to make sure that there's a blend of taxable, pre-tax, and after-tax assets. The goal is to utilize all 3 tax type accounts to manage your tax bracket. Many investors don't realize how withdrawals impact their tax bill until it's too late. I'll give you give you an example. We had a client we started working with after he retired. He was in the 12% tax bracket, but he only had pre-tax assets and he wanted to buy an Airstream. So taking an extra 75 grand from his IRA pushed him from the 12% tax bracket to that 22 marginal percent bracket, meaning that purchase cost him much more than he expected once taxes were factored in. Had he planned ahead, or had he worked with us initially, he could have structured withdrawals differently to avoid this. If he had a Roth IRA, for example, he could have pulled all or part of those funds and avoided being in that higher tax bracket entirely. Strategy number 3, charitable giving. We can use qualified charitable distributions to offset your RMDs. If you're 73 or older, you can donate directly from your IRA to a qualified charity, and it counts towards your RMDs. So why is this so powerful? QCDs reduce your taxable income and lower your AGI. So that means less tax owed and potentially lower Medicare premiums. Here's an example. Let's say we have a client wanting to make a $50,000 charitable donation. If done through a QCD, that client can completely avoid taxes on that portion of their RMD, saving thousands in taxes and supporting a cause they care about. When it comes to taxes, it's not just about what you make, it's about what you keep. Planning ahead with these strategies can save you hundreds of thousands over your lifetime. Look, when it comes to wealth, being good enough isn't enough. Thoughtful, personalized financial planning makes a difference. If you're wondering whether you're getting that level of planning, let's have a conversation. Schedule a strategy session with me, and I'll assess your current plan, identify blind spots, and help you avoid costly mistakes. Make sure to hit that like and subscribe button, and let us know in the comments what's been your experience with financial advisors. Thanks for watching, and we'll see you in the next video.